What's up everyone, you are welcome back to my YouTube channel. It's Arab the Plug again, and this video I'm going to teach you how to trade Forex from the scratch. This is going to be a Forex tutorial where I'll be teaching you how to do the Forex market, how to make money from the Forex market even if you never knew anything about Forex before. And the reason why I'm making this video is because I have made a lot of videos about crypto on my YouTube channel, and I get a lot of questions on how to trade Forex. People want to know how to do Forex trading and how to make money as a Forex trader. Forex trading is a career chosen by a lot of people who make money from it, and you see a lot of Forex traders making money off their laptop doing Forex trading, traveling the world without having to go to any office or doing any official or 9-to-5 job before making money. And the beautiful thing about Forex trading is that you can make as much money as possible from the Forex market, even much more than people who do a 9-to-5 job make in a day or in a month. Forex trading is a very lucrative business, even though it comes with a lot of risk. And that is why, as a professional Forex trader, you have to learn how to manage your risk, how to manage your emotions, and how to do all these things combined with knowledge of basic of Forex trading and technical analysis that I'll be teaching you in this video. So make sure you stick till the end of this video and watch every part of it, because it's going to be really educative. And also, in exchange for the value I'm giving you in this video, I would appreciate if you can hit the like button so that YouTube pushes this video out to a lot of people who are willing to learn about Forex trading. And also subscribe to my YouTube channel so that you get much more videos like this as I post them. Forex trading is a business, like I said, that can make you a millionaire, because the Forex market trades a lot of volume daily. The Forex market trades at least $7 trillion every day, and the daily volume of the Forex market is 200 times bigger than that of the stock market and even the crypto market combined. That is telling you that the market is very big, and you know, when the market trades $7 trillion at least in a day, you as a Forex trader, you should be able to take out maybe $1,000 daily. It's possible if you are a professional. But before you get to that level, you have to understand that the game of Forex trading requires a lot of patience, a lot of rigorous learning and practice, and a lot of mind game, because it's a game of the mind, it's a game of psychology, it's a game of how you think. Because beyond the things you see in the market, beyond analyzing the market, you should be able to control your emotions too, so that you don't get in a trade and you maybe experience a little bit of loss and you run out of the trade because you don't want to see a loss at all. So Forex trading requires that you have the knowledge of basic of Forex trading, which we talk about in this video, trading psychology, and also technical analysis of the Forex market. You might want to ask, can you make money from Forex trading every day? Yes, you can make money from Forex trading every day, because the Forex market is open 24/5, which means that the market is open 5 times a week. 2 days is always an off day for the Forex market, because Forex market deals with banks and other financial institutions all across the world, and the market is always open so far banks are open in the country where you trade. So Forex market is a market where you can make money 5 days out of the 7 days a week. Another question I get asked about Forex trading is that, will Forex trading go into extinction? Which means that, is it going to happen that one day the Forex market will just collapse and we will not have the Forex market again? The Forex market will never go into extinction, because the Forex market deals with currencies, and every country in the world has a currency they trade, they use in their day-to-day activities. So far there are countries in the world, and so far there are currencies these countries use, there will always be the Forex market. Also, one of the questions people ask me is that, can someone choose Forex trading as a career? Yes, you can choose Forex trading as a career, because there are a lot of professional Forex traders today that the only thing they do is trade the Forex market, make money from it, and live their life. Even banks, insurance companies, and other big financial institutions all across the world employ Forex traders, professional Forex traders, to trade for them. So Forex trading is broad, and it is something that can make you a lot of money and you can earn a livelihood from. So let's now go into the details of what Forex trading is and how to make money from it. What is Forex trading? Forex trading, as it implied, means foreign exchange. Forex, foreign exchange. It means the exchange of foreign currency. What do you mean by foreign currency? Foreign currency is any currency that is not being used in your country. For example, I'm in Nigeria. The currency being used in the United States is a foreign currency because it is not being used officially in Nigeria. The currency being used in Ghana is a foreign currency because it is not being used in Nigeria here. And for people that are in Ghana, the currency being used in Nigeria, the Nigerian naira, is a foreign currency. So Forex trading is about the exchange of two currencies. One which is a base currency and the other which will be the cold currency, something we'll talk about later in this video. So to do Forex trading, you need at least two currencies. So these two currencies, what are you doing with them? You are exchanging one currency for another in the pursuit of making profit. So how do you do this? Let me give you an example. If you have traveled from your country to another country, you will need to exchange the currency used in your country to the currency being used in another currency. So the moment you travel out of your country and you exchange that currency of your country to another one, you have done Forex trading. So if you are in Nigeria, for example, and you want to travel to Ghana, you have to exchange your Nigerian naira to the Ghanaian cedis because in Ghana, they only spend the Ghanaian cedis. If you are in Ghana and you are traveling to Rwanda, you have to exchange your Ghanaian cedi to Rwandan franc because the Ghanaian cedis is basically useless in Rwanda if you want to spend it. So foreign exchange, your forex trading is the art by which you exchange two currencies for another. So now talking about the forex market, you know when you exchange two currencies for another in the physical world, like at the bureau de change or in your bank, you are doing it physically. But in the forex market, we do it online, such that we trade some currencies and make money off the difference, which is the exchange rate. You know, when you pair the Nigerian naira and the United States dollar together, as at today, one United States dollar is going to give you 1,100 Nigerian naira as I speak right now. So the exchange rate of USD NGN, United States dollar, paired with the Nigerian naira is 1,100. I hope you understand that because it will require 1,100 of Nigerian naira to get the United States dollars. That is what foreign exchange simply means. So in the forex market, this is how we do it. This is how we make money. You have a pair, which we'll talk about later, which is like the combination of two currencies, and you trade them. So your base currency, which is the currency in which you are trading with, and your cost currency, which is the currency that is seconded, that the second currency in a currency pair. When you trade them, when you have an exchange rate from your broker and you trade them, and you take a long trade or a buy trade, it means you are predicting that the cost currency is going to be weaker against the base currency. And if this happens, let's say you predict that Euro USD is the most traded currency pair in the world in the forex market. If you say Euro USD, you are buying Euro USD. It means you are predicting that the USD is going to be strong, and you are buying USD with Euro. So if you are buying USD with Euro, for example, and Euro starts becoming strong, and you are buying USD with Euro, it means you are losing money. Let me make it in a simpler term. If you are going to, if you are in your country, Nigeria, for example, and you have $1,000, and you buy the $1,000 at a rate of 1,100 per dollar, and then the rate now goes up to 1,150, and you bought dollar. It means the dollar is gaining strength, and with your naira, you are making money. That is simply how forex trading is. So you are buying some currencies within your currency pair in the forex market, and if that currency goes up, you make money. And if you short too, or you sell the currency in the forex market, if the currency goes down, you make money, and if it goes up, you lose money. So that is basically how to make money from the forex market. So why do you trade the forex market? We trade the forex market for different reasons. There are two major reasons why people trade the forex market. Some people trade the forex market to make money. Someone like me and you trade in the forex market. We trade the forex market to make money. And some people also trade the forex market for some other reason, which is non-profit reason. For example, the Central Bank of Nigeria trade the forex market. Every bank or every central bank in every country of the world trade the forex market. They trade their currency with the aim or the ambition of stabilizing that currency, because if the currency is too high in the forex market, in the global forex market, they need to stabilize so that it will balance. and if it is too low, it's going to affect the currency of the country. So you need to put money into it and trade it so that it's going to be stable. So some people trade the forex market for profit reasons, while some trade it for non-profit reasons. The next thing we'll be talking about is the forex market participants. Who are the people in the forex market? Who are the people trading the forex market? We actually have two basic types of people who trade the forex market. We have the institutional traders and we have the retail traders. Let's start from the retail traders. Retail traders are traders like me and you and other people, other traders you see on the internet, you see in your country, you see all across the world, who trade the forex market to make money. Retail traders are just individuals that trade the forex market just for the purpose of making money. Then we have the institutional traders. Institutional traders are different kind of traders. We have the banks, we have the forex brokers, we have the hedge funds, we have commercial companies, we have the central banks and the government. So the institutional traders are institutions who trade the forex market with huge amount of capital, and they call them the market makers. We are the market movers. They are the only people who can move the market because they trade with huge amount of money. So if you see a candle, a movement in the candle or in the market, and you see that you have a very big movement in the market, it is only the retail trader, or it is only the institutional traders that can move the market. So institutional traders trade for different reasons. Banks trade for profit. Banks in the United States, JP Morgan Chase, HSBC banks, all these banks in the United States, they trade to make money for themselves. So as me and you trade to make money, banks also trade to make money, and they trade with huge capitals. Also, the forex brokers, which are institutions that allows retail traders to have access to the market, they also trade the forex market. And you know, forex brokers have a huge amount of money to trade the forex market. Hedge fund companies trade the forex market day in, day out. Commercial companies also trade the forex market. You can have a company, maybe a stock company, a company that deals with steel or anything. They also trade the forex market because they know forex market is also an avenue for them to make more money. And also the central banks and the government. These ones actually trade the forex market with the purpose of stabilizing the currency of their country. They are not really there for profit reasons, like I said in the previous section. They are basically there to make sure that the currency of their company is stable in the global forex world. So these institutional traders are the ones that have the huge amount of money. We call them institutional traders, we call them smart money, we call them market makers. Those people are the ones who have what it takes to move the market. Retail traders like me and you are only to trade the market in the direction of the institutional traders. What are currency pairs? A currency pair is the combination of two different currencies in the forex market. For example, Euro USD, EUR-USD, as you have it on the screen. Euro USD is the most traded currency pair in the world, even though we have a lot of currency pairs in the forex market, which I will talk about very soon. But Euro USD is the most traded currency pair in the forex market, and it has the highest level of liquidity or volume in the forex market. The value of one currency is quoted against another currency, and that is why every currency pair comes with a price tag known as the exchange rate between them. For example, let's come down to our level and use the Nigerian naira for example. If you want to buy $1, you need 1,100 naira of naira. So if you say USD NGN, if you put them together, US dollar stroke Nigerian naira, the exchange rate is $1,100 because you need 1,100 naira of Nigerian naira, which is the base quote currency, to buy the United States dollar. So if you combine two currencies together, you must have an exchange rate, which is the combination of the two currencies, and it is always how much of the second currency you need to get the first currency. So if you have two currencies combined together like Euro USD and the exchange rate is 1.200, it means you need 1.2000 US dollar to get 1 unit of euro, because you know euro is higher and it has more value than the United States dollar. I hope you get that point. If you don't get that point, you can let me know in the comment section, but I think it is clear. So Exchange rate simply is a price tag that is put into a combination of currency pair, which is two currencies paired together in the forex market. So when you pair two currencies together, you have to like find a ground between both of them in which this is the amount that both of them would be traded with each other. So that is what we call a currency pair. The forex market has over 100 currency pairs, like a lot of currency pairs. Base and quote currency. Having understood the currency pair, which is the combination of two currencies, it is important that you understand that this currency pair has a base currency and a quote currency. The first currency in a currency pair is what we call a base currency. For example, Euro USD. Euro is the first currency and it is the base currency. And the second currency pair is what we call a quote currency, which is the currency being quoted against the other. It is the currency being quoted against the base currency. The purpose of explaining what base and quote currency is to tell you how much it costs in a quote currency to get the base currency. Let me put this in a layman language. If you say USD Nigerian Naira and you say the exchange rate for USD Nigerian Naira is 1,100, it means you need 1,100 of the quote currency, which is the second currency, which is the Nigerian Naira, to get what? To get the USD. So if you say Euro USD is 1.2235, that is the exchange rate, right, in the forex market, it means you need 1.235 of USD, which is the quote currency, to get Euro, which is the base currency, because base currency in most cases is usually higher than the quote currency. So the quote currency is how much the currency pair, or the base and quote currency, is simply telling you how much of the quote currency do you need to get what? To get the base currency. So in any currency pair in the forex market, the first currency you see is the base currency. Euro USD, Euro is the base currency. GBP USD, GBP is the base currency. USD CHF, USD is the base currency. USD JPY, USD is the base currency. NZD USD, NZD is the base currency. So in any currency pair, the first currency you see is the base currency, whether it is dollar or not. And the second currency is the quote currency. What is a pip? One of the most basic things you have to learn in forex trading is what a pip is, because the pip is the unit of movement in the forex market. So if a currency pair moves from one point to another, the movement is calculated in a pip. So you probably have heard that, okay, my pip is 20 pip stop loss, my trade is 20 pip stop loss and 60 pip trade profit. Pips is what is used in calculating the movement of currency pairs or any asset, any security you are trading in the forex market. So pip is usually stands for percentage in points, PIP, percentage in points, and it measures the change in value of a currency pair. Also, a pip is always the fourth decimal point in a currency pair, especially if it is not a JPY currency pair. So in the forex market, we have JPY and non-JPY. A pip is usually the fourth currency pair, the first decimal in the currency pair. So if Euro USD, for example, if Euro USD moves from 1.3500 to 1.3505, that is a move of 55 pips. The reason is that this fourth decimal, this fourth number after the decimal point, is the pip. So movement from 1.3500 to 1.3505 is an increment of 5 pips, because this 0 has increased to 5. So in non-JPY currency pairs, the movement is, the pip is calculated by the fourth decimal point. So let's say GBP USD, if GBP GBP USD. If the value of GBP USD is, let's check the forex market for the value of GBP USD. So if GBP USD is currently 1. GBP USD. If GBP USD is currently 1.2467, what is the pip? The pip is this fourth decimal point, which is 7. That is the pip. So anytime this number changes, then you say that the pip has changed. If it turns to 1.2468, that means GBP/USD has increased by 1 pip. If it increases to 1.2469, that is an increment of 2 pips. If it decreases to 1.2462, that's a decrease of 5 pips. So the pip is the fourth decimal number in a non-JPY pair. Non-JPY pair means pair that is not in JPY. So let's say, for example, GBP/USD increased to 1.2470. You can see that the number that 7, for example, before it is 1.2467. So if the last digit increases, it is by 1 or 2 or 3 or 4. But if this number, which is the second to last, increases, which is 6 here, it is an increase of 10. So the last digit is the pip actually, and any increase in the last digit is in the ratio of 1, and any increase in this is the ratio of 10. If this one increases, the ratio of 100, and if this one increases, the ratio of 1000, which rarely happens in the forex market. So if the price moves from 1.2477, 1.2467 to 1.2477, that is an increase of 10 pips, because this 7 is what actually moved, not this this 6 is actually what moved and not this 7. So if there is an increment in price, all you have to do is just you just do a simple calculation of 1.2477 minus 1.2467, and whatever you have is your pip. So pip is usually the movement, the ratio of movement of a currency pair, whether it is increasing or it is decreasing. So the increment and decrease is usually in pip. But for JPY pairs, if you look at JPY pair, you see that JPY are actually always different in the market. If you look at USD JPY actually has a price of, let's open our trading view. Let's open the trading view and see what we are actually talking about. So USD JPY is always different, and the reason why they are different is that their pip value is not calculated by the fourth decimal point, because of this USD card, and the bid price is 1.3816, 1.38, and ask price is 1.3815. So the fifth number is called pipette, which I will talk about briefly before I end this section. So 1.3816, the 6 here is the pip. So if this increases, you can see it has decreased to 1.3815. That is a decrease of 1 pip just now. And if it is increased to 1.16 or 17, that is an increase of 2 or 3 pips, depending on the movement. But if you look at JPY pairs, you can see I have USD JPY, I have Euro JPY. In JPY pairs, the pip is from the second decimal place. So this is Europe JPY. You can see it. Europe JPY is 164.19. So this 9 is the pip. So if if Euro JPY moves from 164.19 to 164.2, that is an increase of 1 pip. If it moves from 161.21, that's an increase of 2 pips. That is how to calculate pips for JPY pairs. Let's look at USD JPY. Let's see if I have USD JPY on my, okay, this is USD JPY. You can see it is totally different from other pairs because they have over 100 in the value, 158. But if you look at other pairs, they are just 1 point, 2 points, 1 point. You can see 0 0.5, 1.4, 1.3, 0 0.9, 1.7, and like that. But for JPY pairs, they are usually very high numbers, and that is why their pip calculation is different. So let's look at what you have in this document and see if you can add a little bit of it. You can see if Euro USD moves from 1.1050 to 1.1055, that's 0.0001 USD rise in value is 1 pip. So a pip is usually the last decimal place of a price quote, right? But so you can see this is a pip, 1.1051. That one movement is a pip. So pipette, like I said earlier on, pipette is the fraction of a pip. You call it fractional pip. It is usually useless in the forex market, but sometimes when you look at your quotes and you look at your broker, they usually add one number after the pip, and it's called the pipette. You can see this number 1.353054. The 4 is the pip and the 2 is the pipette. You usually see it on your broker, but it is basically useless. It really has no tangible value in the forex market. So you can see this is a pip map. This is in 1,000. This is 1,000. This is in 10,000. This is in 1,000. This is 500. This is in 30, which means it is in tens. This is in units, and this pipette is in this is the pipette. So like I said, pip is the 4 decimal page, 1, 2, 3, 4. This 8 is the pip, and this is the pipette, right? So when we calculate pip for this kind of number, this kind of exchange rate, you look at 8, the movement of 8, then look at the next number, then you look at the next one and look at the next one. But in most cases in forex market, these ones, the first 3 numbers do not move. It is usually the last 8, the last one that moves, and that's why I call it a pip. Then if the last one moves to an extent, then the next one that is in tens, that is the highest we usually have in the forex market. So how to calculate the value of a pip? In each currency, it has its own relative value. It needs to calculate the value of a pip for a particular currency pair. So for example, for the purpose of better explaining the calculation, exchange rate will be expressed as a ratio. So Euro USD 1.2500 will be written as 1 euro is 1.2500 USD. I explained this earlier because the quote currency, the base currency, the quote currency is usually how much you need to buy the base currency. So you need 1.2500 of USD to buy 1 euro. That is what we mean by exchange rate. So USD card is 1.0220. It means you need 1 USD to buy 1.0200 card to buy 1 US dollar, which is telling you that 1 USD is higher than card. So if you look at this, right? If you look at USD card, for example, the value in change of the quote currency or the counter currency is used to calculate the pip. So if you look at 0.0001 and you calculate it with this, you will see that if a unit is treated, this is what you get. But to further explain all these things more, let's talk about the concept of leverage and lot size. So if you understand the concept of leverage and lot size, you would understand much more how to calculate a pip. What is leverage and margin in forex trading? It's important that you understand the concept of leverage and margin because those are one of the most integral part of forex trading, and I don't think any retail trader in the world can trade the forex market without the use of leverage, because leverage is a tool provided to you by your broker that will allow you to be able to trade the forex market with a huge capital. So let's come to think of it. If you have $1,000 as your capital, or $10,000 or $50,000, and you are trading in a market that trades over $7 trillion in the world in a day, how do you think you can make money with that your very small capital? That is the concept of leverage, and that is the use of leverage. So if you don't have leverage in the forex trading, you probably will not be able to make any reasonable amount of money from your trade, because if your capital is $1,000 and you enter a trade and you make a 2% profit, that is relatively low to what you can make with the use of leverage. That is why all brokers in the forex market offer something we call leverage, and you as a forex trader, you have a margin. So how do you use margin and leverage in the forex market? So leverage is actually defined as the ability to control a large amount of money using none or very little of your own money and borrowing the rest. So if you are using leverage in forex trading, it means you are putting out your own capital, which is usually a very small amount of money, and you are borrowing the rest of the money. Who is borrowing you the rest of the money? It is your broker. So your broker allows you to use a lot of money. They borrow you the remaining money where you put your own capital. So your own capital is what we call the margin. The remaining money that you use to trade that your broker borrows you is what we call the leverage. So let's look at an example. If you want to control a capital of $100,000 position in the forex market, if you want to control a capital of $100,000 in the forex market, you have to be able to trade as much as $100,000 worth of positions. Position means a particular trade you are currently taking. Your broker will set aside $1,000 from your account. So you need at least $1,000 in your account to be able to trade $100,000 worth of capital with a leverage of 1:100. It means if you multiply your 1,000 by 100, you get what? You get 100,000. So that is why we come about with 100,000. So 100 times 1,000 is usually 100,000. So if you control an account of 1:100 and you have a capital of 1,000, it means you'll be able to access 100,000 worth of capital to be able to trade. If you have a leverage of 1:100 and your account is $100, it means you have access to $10,000 worth of capital to be able to trade. So it means you can trade with up to $10,000 if you have a $100 account with a ratio of 1:100 leverage provided to you by your broker. So 1:100 simply means that any capital you put in your trade, if your broker gives you a 1:100 leverage, which I'll talk about later in this video when I'm teaching you how to register with my preferred broker, Exness. So if your capital is $10, is $100 for example, and you choose 1:100 leverage with your broker, it means you are going to multiply that your capital with 100, which is going to give you the capital you'll be able to access generally in your trading account. So let's say your capital is $50 for example, and you have a 1:100 leverage from your broker. It means your broker is going to borrow you another $4,050 to be added to your $50 to make $5,000 worth of capital to be able to trade in your account. I hope you understand the concept of leverage now. So let's say your capital is $1,000 and you have a ratio of 1:100, which means 1,000 times 100. That means you are controlling 100,000 worth of capital. So now let's say the 100,000 worth of capital investment, you trade with it and it rises to 101,000. Let's say it rises to 101,000. Remember, if you are trading and your capital is $50,000 and you have 1:100, it means 50,000 times 100, which is $5 million in capital. The leverage is not actually the margin or capital you have in your wallet, but it is your ability to trade as much money as possible, more than what you have in your trading account. That is the concept of leverage. So let's say you have $1,000 in your account and your investment is $100,000 because of the leverage you are given, which is 1:100, and you enter a trade with all your $1,000, and you see that with the leverage you are able to trade and you make a profit of $101,000. So it means your capital has risen by another $1,000. So if you have to come up with the $100,000 capital yourself, your return will be a puny 1%, which is $1,000 again. So let's say you are the one that came up with all the $100,000 and you trade and make more than $1,000. It means you only made $1,000 with your $100,000, which is very small. That is why you need a leverage. So if you have $100,000 capital and you use a leverage of 1:100, it means you have access to trade $10 million. I hope you get the concept. So the concept is that leverage multiplies your ability in the market, and it allows you to be able to trade a lot more capital in the market. So now, if your broker give you 100,000 to trade with your $1,000 initial deposit, which is your margin, and you make a profit of 101,000, what happens is that after the profit, after the trade, your broker is going to remove their own $99,000. You'll be left with 1,000, which is your initial capital, which is your margin, and the increment of $1,000 that you have made. Now you'll be left with $2,000. Let me explain it a little bit more. Your initial margin is 1,000, but because you use a leverage of 1:100, you are able to trade with 100,000. Now you trade and you make a profit of 101. Your total balance is now 101,000. Then after the 101,000, your initial capital is 1,000. You are trading with 100,000, which means your broker borrowed you 99,000. Now after the profits of 101,000, your broker now removed their 99,000. You are left with what? You are left with 2,000 from the 101,000. So now the 2,000 is simply telling you that you made 1,000 profit and your initial balance is 1K. So it means you need as much as 100K in the forex market to be able to make just 1K. So now how do you get 100K? You don't have 100K, so you now have leverage. So leverage is simply the ability to use a lot of money to trade. So let's say in a scenario you lose, let's say okay, let me put this there, let me not delete this. So let's say you make 2,000, right? So now let's say your initial capital or your margin is 1,000. Then you have an access to 1:100 level, which means your broker is borrowing you 99,000. Then you have a total margin of 100,000. Now you trade with it, and at the end of the day you lose 1,000. Instead of making 1,000, you now have, from the 100,000 total capital, you now have 99,000, right? Then your broker borrowed you 99,000. So once your broker removed the 99,000, you are left with 0,000, which means you have lost your initial capital of 1,000. That is how leverage works in the forex market. So that is pretty much how leverage works. So leverage allows you to control a very high amount of money in the forex market. And once you know that this is what leverage means, you should be able to control your leverage. You should not use too much leverage, because too much of borrowed money exposes your capital to a lot of risk. So now in the forex market we have different kind of leverage, right? Leverage is actually very sweet. It's borrowed money, but technically it affects your capital, because the more exposed you are to borrowed money, the more exposed your capital is to a lot of risk and to a lot of loss, just like the example I gave you just now. So now your broker, most of the time your broker requires a 1% or 2% margin. If your broker requires 2% margin, then you have a leverage of 50:1, and this is how leverage works. Minimum leverage in the forex market is usually 1:20. It means your broker require 5% of your margin. So if your margin is $50, that is 50 times 20, that is 1,000. So your broker requires 5% of that 1,000 deposit. So your margin must be 5% deposit for you to be able to use 1:20 leverage. So we also have 1:33, 1:50, 1:100, 1:200, 1:400. Some broker offer as much as 1:1,000, 1:2,000, but that is too risky. So For a beginner forex trader or even an advanced forex trader, don't go beyond 1:100, because you are literally multiplying your account by 100. So if your account is $100 and you have a leverage of 1:100, it means you have capital worth $10,000 to trade. So it means you are trading $10,000 with an initial deposit of $100, which is too risky for your $100. So you have to be able to control your risk appetite before you enter a trade, and that is going to lead us to what we call forex lot sizes. What is lot size in forex trading? Lot size is one of the concepts that is very important in forex trading, because you hardly can trade forex without understanding what lot size is. And whenever you want to enter a trade in your trading account, your broker is going to tell you to select what lot size you want to use to enter a trade. So a lot in trading is the unit of measuring a transaction amount. Lot size simply means this trade you currently want to go into, how much of your capital plus leverage do you want to use? You know, I said earlier in the previous session that leverage is more like a borrowed money. Yes, your broker is borrowing you a lot of money. Now, from this borrowed money, how many units of it do you want to use to enter the trade? So now let me give you an example before I get into these documents. Let's say your broker borrows you 100,000 units of currency, which is like 1:100. So let's say your capital is 1,000. Now your broker is now borrowing you another $99,000. Now you have 100,000. If you use one lot size, it means you are going into the trade with all your capital, which means if you lose that trade, you lose all your accounts, you lose all your money. Once you lose the 1,000 in your account, your broker is going to pull out their own 99,000 and you are left with $0. So lot size is the unit of measuring how much unit of currency do you want to use to get into a trade. So let's look at what you have here. It's like an egg carton or egg box in the British English. And when you buy eggs, you usually buy a carton, right? Now, in the carton, you have 12 eggs. Now, if you want to cook in your kitchen, you have to select, okay, from these 12 eggs, how many do I want to cook today? The more egg you cook, the less you have in your carton. That is what lot size simply means. The more lot size you use in a trade, the less balance you have in your account, because you are literally exposing yourself to a lot of risk if you are using a high level or a high amount of lot size in your trade. So now, the standard size for a lot is 100,000 units of currency. And now there are also different standard amounts of currency. So we have standard lot in the forex market. We have different lot size. We have standard lot, which is 100,000 units of currency. We have mini lot, which is 10,000 units of currency, and we have micro lot, which is 1,000 units of currency. We also have nano lot, which is like 100 units of currency, but nano lot is usually not in use by a lot of brokers. So we have standard lot. So in the forex market, standard lots usually comes in forms of, let me get rid of this. Standard lots usually come in form of 1, right, which is 100,000 units of currency. Then we have the mini lot, which usually comes in form of 0.1, and we have the micro, which usually come in 0.01. 0.01. So if you are trading, we'll get there when I'm explaining how to use lot size. If you are using one lot size, it means you are trading with standard lot, which is usually 100,000 units of currency. If you are trading with 0.1 lot, it means you are using 10,000 units of currency, which is the micro lot. And if you are using 0.01 lot size, it means you are trading with 100 units of currency, or 1,000 units of currency rather, which is usually the mini lot. So let's say your account is 10,000. Your account is worth $10,000 with your leverage. Let's say you are using 1:100 leverage. Your account size is like $100, and you are using a micro lot. You won't be able to exit 0.1 lot size. And what I mean by 0.1 is maybe 0.1, 0.2, 0.3 to 0.9. you won't be able to go to one lot size. And if you're on one lot size, you are using a standard lot size, it means you can use one lot, 1.1, 1.2, 1.5, 2, 3, 4, 5 lot size, 10 lot size, 100 lot size. So it is more of a standard. The standard lot size is 1 lot size and above. The micro lot is 0.1 and above, and the mini lot is 0.01, 0.02, 0.03, 0.05, 0.09, like that. So lot size is measuring the units of currency you're actually using to enter the trade. And the more the unit of currency, the more leverage you are using and the more exposed you are to risk in forex trading. So now, lot size, standard lot is 100,000 units of currency. It doesn't mean $100,000 actually. It means the units of currency you are borrowing from your broker from the available leverage you already have in your account. And that is why the concept of lot size and leverage work together. If you don't use leverage, you won't be able to use any lot size because you'll be trading directly with your capital. But if you are using leverage, you'll be exposed to a lot of capital to enter your trade. But now that your broker is borrowing you money according to your leverage size and your account size, your balance, will be able to determine what lot size you'll be able to use. So if you have leverage and account balance that gives you access to up to 100,000 or more units of currency, you're able to use standard lot. If your account size and leverage size restrict you to 10,000 and above, less than 100,000, then you'll be able to use mini lot. And if your account size is like in thousands, in 1,000s to 2,000, 3,000, 10, 8,000, 9,000, 8, 9,999, but it's less than 10,000 balance with your leverage, you'll be able to use micro lot size. That is it. So, as you already know, the change in currency value relative to another is measured in pips, which is very, very small percentage units of the currency value. To take advantage of this minute change in value, you need to trade large amounts of particular currency in order to see significant profit or loss. That is what I explained. You know, the change in currency value is pips. So let's say Euro USD or USD JPY move from 119.80 to 119.81. That is one pip movement. For you to be able to make a lot of money from that one pip movement, you need a huge account size, and that is where lot size come in. So now, USD JPY and an exchange rate of 119.80 is 0.01 times 119.80 times 100,000, which is the standard lot size. For per one pip movement of 100,000, which is the standard lot, which is 1, it is $8. So you are making $8 per pip for a standard lot, right? So that is why you need, imagine 100,000 units of currency and you are making just $8 per pip movement. So you need, like, maybe if you make, so if your market makes like 10 pip, it means you are making $80. If the market moves up by 100 pips, it means you are making $800 with the standard lot size. So you need a lot of pip movement and you need a considerable, reasonable amount of lot size or borrowed funds to be able to make money in the forex market. So also, in the cases where US dollar is quoted first in non-JPY currency pairs, let's say Euro USD is 1.1930, which is like one pip movement is 0.0001 times this amount, which is like the profit you make per pip, times the rate, the exchange rate, times 100,000, which is 8.38 per pip, if you are using the standard lot size. You understand? So it's telling you that the money you make per pip is normally too small for you to be able to make any reasonable amount without a lot size. But still, you still have to regulate it depending on your account size so that you don't blow your account. So if you want more details about how this works, you can actually visit this site, Baby Pips, and I'm going to put the link to all these pages in my description below so that this video will not be too long. But basically, the point in this video is that you have to understand that the lot size is what gives you access to you'll be able to use the leverage you already have selected in with your broker, and you have to be able to regulate it. So you have to be able to trade according to your account size. If your account size is low, it is in thousand with your leverage. So let's say you deposit $50 and you have a leverage of 1:20 or 1:50. Remember, 1:50 leverage is 50 times your deposit of $50, which is $2,500 worth of currency you're able to trade. So with $2,500 accounts, with $50 accounts and 1:50 leverage, remember you can't trade more than $2,500. So with $2,500, your account size fall under micro lots. So if you are trading, you have to stick to micro lot size to be able to make money. So if you are trading with micro lot size, it means your leverages will be, your lot size will be 1.01 or 1.02, 1.03, 1.04, 1.05, 1.06, 1.07, 1.08, 1.09. So you have to calculate your lot size, your lot size, by understanding how much worth of currency are you actually exposed to, by multiplying your leverage by the amount of margin you are depositing in your accounts. What is a spread? Forex brokers, when you are trading the forex market, will give you two prices for each currencies. And if you look at your MT4, you would see it there. So when you go to a bank or you go to your bureau de change and you want to exchange money, you would see that they always have a sign or a kind of plaque where currencies will be displayed, and they are going to tell you a price they are buying and the price they are selling. The price at which a broker is willing to sell the base currency for you is called the bid price, and the price at which a broker is willing to sell the quote currency for you is called the ask price. So forex brokers will always give you two prices, the bid price and the ask price. So the bid price is, okay, if you are buying this currency, this is the price. And if you are buying these currencies, this is the price. And the difference between these two prices is what is called a spread. For example, if you go to a bureau de change and they tell you, okay, you want to exchange your Nigerian naira, for example, to the United States dollar, we will buy from you at 1,150 and we will sell to you at 1,100. What is the difference between how much they are selling to you and how much they are buying from you? 50 naira. That is the spread. So every forex trader in the forex market has a bid price and an ask price. So the bid price is how much they are selling the base currency to you. The ask price is how much they are selling the quote currency to you, how much they are buying the base currency from you. And this is the difference between both of the prices is what we call the spread. Spread is how the forex brokers make money. Now let me explain to you why. Forex brokers, forex brokers are platforms that give you access to the forex market. Literally, forex market is being traded by big banks, financial institutions all across the world, and you as a trader, because you don't have enough money to be able to trade the market, forex brokers are intermediaries between you and the market. And because they have a lot of money and they can give you a leverage, which I have explained earlier on, which is going to allow you to be able to trade in the market, because you can't trade with literally your $100 or $500 or $2,000 or $10,000. You can't make any minimum profit with that. So forex traders would get a price from the market, then they will add a little to the price so that they can also make money. So when they get a price at a certain amount, they can just add a little to the price and they will give you the bid price. Then the ask price they get from the global market, they add a little to it and they give you the ask price. That is how the forex brokers get the bid and ask price. And the difference between the prices is what we call the spread. So the spread is how they themselves make money from the forex market. A spread in the forex market is measured in pip. And like I said earlier on, a pip is equal to 0.0001. That is the value of 1 pip. So spreads are always measured in pip, because pip is more like the units of movements of the forex market. Forex trading sessions or forex trading hours. What are the time you trade the forex market? What are the time when the forex trading market is open? Like I said at the beginning of this video, I said the forex trading market is open 24/5, which means it is open for 24 hours a day for 5 days in a week. So let me give you more breakdown. Forex market closes every Friday by 10 p.m. and it opens every Sunday by 10 p.m. It means Sunday night, the Forex market opens by 10 p.m. and it will be open until the night of Friday. 10 p.m. it closes. So it means Saturday and Sundays are days by which Forex market do not open. And this is logical because on Saturdays and Sundays, banks are not opened. Financial institutions are not open. Hedge funds are not opened. Most or majority of the companies are not open. So that is why Forex market do not trade at these hours. So Forex markets trade 24/5, which is 5 days a week, 24 hours every day. Now, the Forex market has 4 different sessions. We have the London session, which is also called the European session. We have the New York sessions, which is also called the American session. And we have the Tokyo session, which is also called the Asian session. And we also have the Sydney session, which is also called the Australian session. What do these sessions imply? These sessions represent the time at which the Forex market opens in every country. And the busiest of these sessions is London session because the majority of the trading volume in the Forex market comes from Europe, London, the UK, and other European countries. So the London session is the busiest session in the Forex market, and it opens at 8 a.m. London time or 8 a.m. GMT. So looking at the GMT now, looking at using the GMT time session, London session opens 8 a.m. in the morning, London time. And all other sessions also, they open 8 a.m. at their particular location. So 8 a.m. in London is when the banks open. So 8 a.m. in London is more like 8 a.m. in Nigeria too. So if you're in Nigeria, you can trade London session 8 a.m. and it closes by 5 p.m. London time. The New York session open at 1 p.m. GMT, which is like 1 p.m. in Nigeria, and it closes at 10 p.m. Nigerian time. Tokyo session opens at 12 a.m. Nigerian time, but that 12 a.m. is 8 a.m. in Tokyo. I hope you understand. So all these sessions open at 8 a.m. in the respective countries. Tokyo is in Japan and it represents the Asian session. And so New York session opens 1 p.m. GMT and it closes 10 p.m. GMT. Tokyo session, which is the Asian session, opens 12 a.m. in the midnight, 12 a.m. GMT, and it closes 9 a.m. in the morning, just an hour after the opening of the London session. And Sydney session opens 10 p.m. at night. It is actually 8 p.m., 8 a.m. in Sydney, and it closes 6 a.m. in the morning, just 2 hours before the opening of London sessions. So what do these sessions imply? These sessions imply the times by which banks, companies, and financial institutions open in these states or in these cities. And these cities are usually used to represent countries or some regions in the world. So London is representing Europe because London is the biggest financial place in the whole of Europe. London is the center of finance in Europe. New York is the biggest financial hub in the United States of America. Tokyo is the biggest financial hub in the whole of Asia. And Sydney is the biggest financial hub in the whole of Australia. How do you trade this session? London session is usually the busiest, like I said. It has a lot of liquidity because majority of the people that come into the market and bring big money into the market are from Europe, the HSBC banks and all those financial institutions in Europe. They start the trading session by 8 when banks open in London. When banks open in London, London session starts. And this is when liquidity, we have the highest volume in the market, followed by New York session, because New York is the financial capital of the United States. So now we have an overlap of London and New York session, and that is the best time to trade the Forex market because when London session and New York sessions meet, we have a lot of liquidity in the Forex market. So you know London session starts 8 a.m. to 5 p.m. and New York session starts 1 p.m. in the GMT time. So between 1 p.m. when London session is still open and when New York session has also opened is the best time ever to trade the Forex market. The essence of talking about the Forex trading sessions is so that you as a trader can know the best time for you to trade. and that is why I have decided to talk much more about the trading sessions. So for you as a trader, the best time to trade is the London session because the banks and financial institutions in London and other parts of Europe are open. Now the next best time is the New York session. But between London and New York session, there is a time where both London session and New York session overlap, and that is between 1 p.m. when New York session opens and 5 p.m. when the London session opens, and you know it is GMT, Greenwich Meridian Time. So that is the best time to trade because there is an influx of liquidity in the market. Also, Tokyo session is usually characterized with a very low amount of volume in the forex market, same as Sydney session, even though Tokyo session seems to be more volatile than Sydney session. But then when there is an overlap of both Tokyo and Sydney session, we also have a very reasonable amount of volume in the forex market. So you have to be able to understand these sessions, which one suits where you are trading from and which one suits your trading strategy, and also when do you really have time to trade. You also have to understand maybe you do a 9-to-5 job and you trade part-time. You should be able to understand all these things to be able to find the best time for you to trade. But overall, the best time when we have a lot of volume and liquidity in the market is during the London session, New York session, and when we have London session and New York session coming together, and we have an overlap of both London session and New York session. How do you manage your risk as a forex trader? Previously, I said that the forex trading market trades more than $7 trillion every day, which means there's a lot of money in the forex market. But there is also a lot of risk attached to being a forex trader because you are a small player between a lot of players in the forex market. So you with your 10,000, 20,000, 50,000, 100,000 or $1 million account, you are just a small fish in an ocean full of big sharks and whales. So as a forex trader, you must be able to manage your risk, and that is why in the forex market you see that people say they have blown their account. I just blew my account. You see someone saying they have blown 5, 10, 15 profile accounts. Some people have blown accounts worth of $10,000, $100,000 within minutes. They lose all their accounts. How do you manage your risk in forex trading? I'm going to give you 5 different tips on how to manage your risk in the forex trading. The first one is understand how forex works. Happily, you are already on the verge of understanding how the forex market works by watching this video. So you have to be able to understand what forex trading is and how it is done. You have to understand all the concepts that are attached to the forex trading that will be mentioned in this video. So make sure you watch to the end, and also understand how to do technical analysis. Proper technical analysis of the forex market is going to teach you how to buy, how to sell, how to know when the market is going to move up, and how to know when the market is going to crash, so that you'll be able to make money from both the upward movement of the market and the downward movement of the forex market. The second tip is to get a grasp of leverage. You have to understand the concept of leverage. We already explained the leverage in the previous sessions, but you have to understand that leverage is a two-edged sword, which means as much as leverage can help you to make more money in the forex market, it can also ruin your trading career. It can help blow your accounts. It can help with the liquidation of your trades. So make sure that when you are selecting a leverage with a broker, make sure you select a lower leverage. There are some countries in the world that make sure that all the brokers in their country do not surpass 1:50 leverage. Like the United States of America, they regulate this. But there are some countries also that these things are not regulated, and you have brokers offering up to 1:2000 leverage in the forex market. This is an absolute mess, and it is too risky for a forex trader. So make sure you don't get it wrong when it comes to leverage. The third tip is to build a good trading plan. Trading plan, if you want to go fish, for example, you take the things you need along, and you have a strategy by which you fish. You know that in the afternoon, this is where the fishes would likely be. In the morning, this is how the fishes would likely react. In the evening, this is the best way to get hold of the fishes. So you as a forex trader also see forex trading as a hunting game, whereby you have a lot of millions of participants in that game, and everybody is trying to hunt. Everybody is trying to hunt for money, actually. So make sure you have a good trading plan, which is going to direct you, okay, this is how I want to take my trade. These are the criteria I want to see in the market before I place a buy or sell trade. This is how I want to think before entering a trade. When I'm in a trade and I'm in a loss, this is how I should think. And I must make sure I think that way. All these things must be written and noted, and you have to revise them time to time so that they remind you of your goal and how to get to them. So trading plan is something every forex trader needs. And look at the most forex traders in the world. Almost all of them have a trading plan. Another thing you have to understand to be able to manage your risk as a forex trader is that you need to understand the concept of risk to reward. Risk to reward is simply the act of understanding that for you to get a reward in the forex market, you must be willing to take a certain risk. So you must be willing to risk something to get another thing. So when you are taking a risk in the forex market, it must be a calculated risk, and your reward must surpass your risk. For example, if you learn technical analysis, which is something we'll talk about at the end of this video, technical analysis is going to teach you that, okay, in the forex market, when you're trading the forex market, you should have a stop loss. Your stop loss should be a reasonable amount of risk you are taking, which means stop loss means, okay, if the market goes against my plan, then stop me out at this point with some loss. So you should understand how much you are going to risk in terms of pips before setting up a trade, before getting the trade. And you should understand that, okay, if you are risking this amount of money, you should be able to get a certain reward that is reasonable and that is not too much. For example, if you are risking 20 pips for 60 pips, 70 pips is very reasonable. If you are risking 20 pips for 200 pips, 300 pips, it makes no sense. It's like you are risking 50,000 naira, for example, for a million naira profit. That is too much of a risk because your reward is too far from the risk you are willing to take. So the amount you are willing to lose in a trade should not be too far from how much you want to make in, so that you get into the trade, you make what you want to make, and you get out of the trade fulfilled. Use stop and limit orders. This is the fifth tip I'm going to give you on how to manage your risk as a trade trader. You don't necessarily have to be on your screen every time. When you understand how to do technical analysis, you will know that you can simply time the market by looking at the chart and say, okay, this is exactly where I want to enter. If the market gets to this stage, then I should be able to enter. So you can just use stop orders or limit orders to enter your trade, and stop orders also to enter your trade or to get out of your trade. So in essence, have stop losses, have take profits, have targets set for your trade, and let the market take the target for you, the profit for you, automatically without having to be there. So whether you are at your home, whether you have a side hustle, whether you have an occasion or a party, or you are balling in the club, your trades can run itself, and you can make or lose money while doing all these things without having to stay glued to your screen. Types of forex orders. What are the kind of orders you can place in the forex market? We have three major kinds of forex orders in the forex market. We have the market orders, we have the limit orders, and we have the stop orders. The market order is simply what it is. You are buying an asset, or you are trading the market by buying or selling at the current available price in the market. The most available price in the market is what we call the market order. So if you click on buy in the forex market, the trade will be executed at the most available price at that time in the current market. That is what the market order is. But as for the limit and the stop orders, they are divided into two, and let me explain. For the limit order, we have the buy limit, and buy limit means you are simply buying us at the price that is below the current price. Let's say the price of Euro USD is 1.2536, for example, and from your analysis, you feel that Euro USD is going to drop to 1.2000. So you can now set a buy limit at 1.2000 such that once the market drops to that price, the market is going to, your broker is going to execute your trade for you immediately, your buy trade for you immediately. That is what a buy limit means. It means you are trying to buy at a price the market has not reached at that moment. When you click on the buy that is a buy limit, your broker is going to wait until the market reaches that limit price before it buys for you. Also, we have sell limit. Sell limit means you want to sell, but you want the price to go up before you sell. So sell limits are orders placed above the current market price. So you want to sell Euro USD, for example, and the price of Euro USD currently is 1.2536, for example, and you want the market to go to 1.2542 before you sell. Let's say you are already in a trade, or you want to take a sell trade, and you predict that the market is still going to go up, maybe to a resistance, and reject that resistance. You can place a sell limit for the market to go up to that place and pick your sell order and then sell. So that is what a sell limit simply means. Apart from the limit order, we have the stop order. The stop orders are also divided into two. We have the buy stop and the sell stop. Buy stop are orders placed above price and price keeps going up. For example, Euro USD is 1.2536 and you want to buy it at 1.2539. It means you are placing your buy above the current price. You know, for buy limit, it is below the current price, but for buy stop, it is above the current price. And for sell stop, it means you want to sell, but you want the price to drop more before you sell. So it is directly opposite to sell limit. Sell limit means you want the market to go up before you sell, but sell stop means you want the market to continue to go down, then you sell. That is the kind of forex orders we have in the foreign market. I'm going to explain this much more when I get to how to use the MetaTrader 4, and you see the practical examples of how to use market order, limit order, buy limit, sell limit, buy stop, and sell stop. Now let's talk about forex brokers. What is a forex broker? You can't trade the forex market without having a broker. And let me give you an example. Say you, as a traveler, you want to travel by water and you want to cross the Atlantic Ocean. And Atlantic Ocean is a very, very big ocean, one of the biggest and the largest in the world. And now you want to cross this ocean, you need a canoe or something like a canoe that will convey you from your point of entry to another point. And then in the Atlantic Ocean, you have a lot of big ships trying to move across the world, from Europe to Africa, from Africa to Asia, and like that. So now, you know that these ships are very big, and you really need something strong to be able to move in the water, because the water is a very, very deep stuff. And if you try and go in with a very tiny canoe, like the regular canoe that we used to have, you are likely going to sink in the water. That is a similitude of the forex market. You now need a ship that is also big as well. This ship that you need to pass through the river might not be as big as the large ships and cargoes that moves goods all across the continent, but you need a substantially big one that would be able to stand on the water, because the water is very deep. That is a similitude of a forex broker. A forex broker is a particular financial platform or financial service company that provides traders, retail traders, with access to platform to be able to buy and sell in the forex market. Because you, as a trader, you probably have $1,000, $2,000, $3,000, $10,000, $50,000, $100,000. All this money do not have any weight in a $7 trillion market. A market that trades $7 trillion every day. In a market where we have banks like HSBC, Chase Bank, and all these big banks in the United States and the UK, Europe, Asia, and other parts of the world. So your money is like a drop of water in an ocean. You won't be able to sail through in that big ocean without having a broker that you will tag along with. So the broker comes to the market, and the big banks, the big ships, give the broker access to a very large part of the market. Now the broker has a lot of people who want to trade on their platform. They now bring all your money together so that you will be able to trade. Also, your broker provides you with a leverage, because they have the access to big money in the market. They give you a leverage which allows you to be able to swim or to be able to move through this very large ocean, which is Atlantic Ocean, like I said earlier, so that you'll be able to scale through and travel to your destination. So forex brokers are those companies that give you retail traders access to the market, because on a normal day, you as a retail trader do not have the platform to trade with the financial institutions and other market participants that are institutional traders in the forex market. Now let's talk about the types of forex brokers. We have two major types of forex brokers in the forex market. We have the dealing desk brokers and the non-dealing desk brokers. What is the difference between these two brokers? The dealing desk brokers are also called the market makers. They are the kind of brokers that make the market. And what do? What they do is that they have a platform and they create a market for themselves. Whatever happens within the brokerage, all the trades that is happening by people who use the broker is actually not connected into the general forex market in the world. They call them market makers. And what they do is that when you place a trade, for example, if you place a trade for GBP USD buy, they have to place another trade against your own trade. They have to place a sell trade against your own trade, because in the forex market, all the trades you are placing in the forex market are being paired against other trades. In the forex market, if you are buying an asset, if you are buying GBP USD, your trade must be paired with the trade of someone that is selling GBP USD. If you are buying NZD CHF, your trade must be placed against someone that is selling NZD CHF at the same amount you are selling it. That is how the forex market works. So if you are using a dealing desk broker, they are not actually connected to the other big banks and traders all across the world. They make a market for you to be able to trade, and they place a trade against your own trade. That is why a dealing desk broker is always fast, because they are the ones they are the ones taking the trade against you, and they are prone to manipulation. They tend to manipulate trade, because when you are making money, they are losing. And a good brokerage is not supposed to operate that way. A good brokerage is supposed to make money whether you lose or make money, and that is what a dealing desk broker is. So dealing desk brokers or market makers are brokers that create a platform for you to trade within themselves, and they pair your trade with their own trade. So that means if you are taking a long trade on a particular currency pair, they must be taking a counter trade against you, and when you make money, they lose money, and when you lose money, they make money. And this is not the best way to trade. There are pros and cons of dealing desk brokers. One of the pros is that they are very fast and they offer low commissions, because they literally make money when they trade against you, and they have a very tight spread. But one of the cons is that they tend to be manipulated, to manipulate your trade. They can manipulate your trade so that they can make much more money from the trade. Another con is that your trade is not carried out in the global forex market, and this is not an ideal way to trade. Also, one of the cons of dealing desk broker is that these brokers make money when you lose money, and this is not really an ideal brokerage firm. The second type of brokerage firm or brokers is what we call no dealing desk broker. No dealing desk broker is a kind of broker that allows you to trade, and whenever you trade on their platform, your trades are paired with other trades all across the global forex market, and they use a system called STP, which is straight through processing, which means when you are using a no dealing desk broker, whenever you place a trade, your trade will be paired, will be transmitted into the current forex market all across the world, and it will be paired with someone else who is placing a counter trade against you. So if you are placing a buy for Euro USD, for example, on a no dealing desk broker, they are going to look for someone else in the forex market all across the world. The person might be in Indonesia, the person might be in Malaysia, the person might be in the United Kingdom, and they are going to pay your trade against the trade of that particular person. That is how no dealing desk broker operates. So no dealing desk broker is the best kind of broker to use, because of the fact that most of the time they hardly trade against you. They are transparent. Their transparency, because they don't really have anything to lose. They majorly make their own money from spread, like I explained earlier on. Also, there is no conflict between brokers and traders. And when there is no conflict between both of them, they tend to work in the same direction, which means the actualization of trading of their customers. One of the cons of no dealing desk broker is they have a wider spread, because spread is how they make money from the market, and they also charge a very high commission compared to dealing desk brokers, because they have to find a way to make money, whereas dealing desks do not really have to find other ways to make money, because naturally they will make money from spread, and when they trade against you, they will also make money. How to choose the right broker? One of the mistakes a lot of forex traders make is that they choose the wrong broker and they tend to lose money. They tend to have issues with their trade. They tend to have issues with deposit. They tend to have issues with withdrawal. And the list of the things you want in your forex trading journey is that you trade with a broker, you make money, and you're unable to withdraw. There are countless complaints all across the internet of people who have traded and made money from the forex market, but they are unable to withdraw, or their withdrawal with their broker has been pending for days and weeks and months. This is the list of things you would want as a forex trader. That is why it is important that you know these 5 tips that I will give you on how to get the right broker. The first thing is regulation. The broker you would use must be regulated in the country where you are. You must choose a broker that follows all the regulations and that is duly registered by the appropriate bodies in charge of the forex market in your country. So once the broker is regulated, you'll be assured that you can actually put up any complaint to the regulatory body whenever you have issues with your broker. The second thing you have to look at is customer service. You have to make sure that you use a broker that has the best customer service in the market. And that is why, when you have issues, you can easily reach out to them and they can solve your issue in no time. So, you don't want to be dealing with a company that when you send them an email, maybe you have a complaint and they respond after 5 days or after 2 weeks. That is absolutely bad. So you have to make sure that you choose a broker that has a very good customer service relations with the users of that broker. The third one is spread and fees. In as much as no dealing desk broker are the best brokers to use, you also have to consider the fact that when you make money, you don't want to get caught up with spread, such that whenever you place trade, sometimes your entries get missed and you don't get to make money from the trade if the trade actually goes in your way. Because spread is the way by which brokers make money. They tend to adjust rates due to whatever they get from the global forex market or from their provider too. So when spread are adjusted, you tend to miss out on some entries. So you have to choose broker that has a very low spread and a very low fee, because when you make a lot of money and your broker is charging maybe 10% or more of the amount of profit you have made, it is outrageous and ridiculous. You don't want to be caught in that kind of trap. Also, one of the things you have to look at before you choose a broker is the market offer. What are the market offered by this broker? If you trade forex, maybe you trade commodities like gold, like silver, you trade US oil, you trade crypto and other things on the forex market, you need to be sure that the broker you are trying to choose has all these things on their platform before choosing them. It is very important, because if you trade gold, for example, then you go ahead and sign up with a broker that does not offer that service, or a broker that does not have US oil or UK oil or whatever commodity you want to trade, like silver, like metal. If your broker does not have them and that is the thing you want to trade, you won't be happy with that. So make sure you look at the market offered by your broker and choose the one that offers the range or a variety of market that you might be interested in trading. Also, the last one is withdrawal. When you make money from trading, the worst thing is not being able to withdraw, or maybe working with a broker that's going to take a very long time for withdrawal. Choose a broker that's going to process your withdrawal within minutes or a few hours, maximum of 24 hours. Any broker that offers withdrawal for more than 24 hours or days, weeks, is not really a broker you should be working with. And that is why I will recommend you a trader that I've been using for a very long time, and they are trustworthy and they have stood the test of time in the forex market, which is Exness. If you want to sign up with Exness, and this is something I'll talk about later in this video, how to use Exness. If you want to sign up with Exness, there's a link down in the screen below. You can use the link to sign up with the broker that I use, And in the next episode, I'll be teaching you how to use this broker, how to sign up on a broker, and how to connect your broker with your trading platform, which is usually MT4 or MT5. Let's talk about how to sign up an account with a broker. Like I said, my preferred broker is Exness, and I've been using broker for a very long time, over 2 years, and they have stood the test of time, very trusted. Their withdrawal is they allow withdrawal in different methods. You can withdraw in Naira, you can withdraw in crypto and other methods. So this is Exness page. If you want to sign up, the first thing you do is go to Exness page, my.exness.com. The link is description below. So just click on the link and you will be able to have this page that I have. Then I'll be signing in to Exness. But if you don't have an account already, all you have to do is create an account by just clicking on create account. So once you click on create account, it's going to bring you the page where you create the account. You select your country, which is Nigeria. You select Nigeria, right? This is Nigeria because this broker is available in almost every country in the world. You put in your email address, you follow all the necessary steps, and you sign up. So once you sign up, you have this page. So for me, I will be logging in because this is not a new account that I will sign up. So I will log in. So once you log into your account, this is what you have. So you have this particular page, and what you have to do is that you deposit into your account. But before you deposit, one of the things you do is that we have trading platform called the MT4 and MT5. MT4 and MT5 are the platform where you trade. You understand? So they are the platform where you trade. But your account, your broker account is the account where you used to trade. For example, now, when you sign up an account with a broker like Exness, you have to open an account. Then, when you open an account, you select the trading platform you want to use. So, your broker will now give you login and password that you will input into your broker account. So let's do a demo. Let's open a demo account with my broker account and let's see how to do it. So let's click on open an account. So once you click on open an account, you select the type of account you want to open. Is it standard, is it pro, and is it raw spread account or zero account? So let's say I want to open a standard account. Right, you select your leverage. So like I said, leverage is it real account or demo account? Let's use demo account because demo is like an account used to demonstrate before you start depositing real money. If it's a real account, you have to like deposit a real money, but it's a demo account, they will just give you a demo money to trade, to practice. So yeah, to select leverage, I actually select 1:50 or maximum of 1:100, just like we have learned about that. Then starting balance, what balance do you want? Let's say 5k. Then currency is US state, and you put in your password. Let me just put in my password. So I put in my account, then my password, my account is being preferred. So I need to okay, it says my trading account 1539 has been prepared. So now, this account has been prepared. It is demo, which means it is a demo account. I can't use the money I can't withdraw the money. I can only trade with it and practice. Then it is MT5. MT5 is a platform where I would trade. Then it is a standard account, and this is the account details. So I can set the balance and add more money to the balance. Let's say I want to set it to $50,000. I can set the balance to $50,000 because it's a demo account. It's practically not anything. Then I can trade. So if I want to start trading with the accounts, let me just click on trade. Then I can click on MetaTrader 5. MetaTrader 5 can also be used on the on laptop. If you have it on your laptop, you have the app on your laptop, but I prefer to use it on trade. So all I have to do now is that I would look at the login of this demo account, and I will log in the demo account on my MetaTrader 5 and show you how to use the MetaTrader 5 and how to trade with the MetaTrader 5. So it's pretty much the same thing. If you are not using MetaTrader 5, or if you deposit money through like real account, if the account you open is real and not demo account, it is just the same process that you use to set up the account. So you can look at your account by clicking my accounts here, and you can deposit here, you can withdraw here, you can check your transaction history by clicking on it. You can use crypto wallets on this account too, so that you can deposit with crypto. You can look at analytics, you can look at portfolio management. Like if you have some money in your portfolio, you can manage it through by clicking here, right? You can manage your investment, wallet, social trading, and other things. Also, you can check your balance right here. You can transfer, you can withdraw, you can add to your crypto. And one of the things you can also do is you can check your personal area. You can check SS terminal, like a page where you can trade directly on Exness, and every other details. So this trading account that I just opened, which is demo account, you can look at the account information by just clicking on this, right? So this is the account information. So now if you want to log into this account on MT5, all you have to do is look at this information. This is the account number. The platform is MT5. The type of account is standard account. Server is Exness MT5 trial. Free margin is the amount of money you have there, is 50,000. Actual leverage is 1:100, and market leverage 1:100. It is this information that you use to log in the account on your MT5. So if it is MT4, it is the same thing. You'll be the one that will select whether you want to use MT4 and MT5 when you are trying to sign up on your Exness account. Also, if it's a real account, it's pretty much the same thing. The difference is that you have real here and your account will be created. So after creating the account, you now go ahead and click on deposit and deposit into that account. So once you open an Exness, you still need to create an account, a trading account, and the details of the account, which is the server, and the number, will be the thing that you use to log in on your MetaTrader 4 or MetaTrader 5. So that is it. So now, the next thing is that you will now go on our MetaTrader 5 and log into this account. And I will also show you my other account on MetaTrader 4 that I used to trade. That is not this particular demo account that I trade on, and I will show you how to do some other things right there. Now let's talk about how to connect your MetaTrader 5 with the demo account you opened on your Exness broker. So once you open an account on your broker and they give you a login, all you have to do is go to your MetaTrader 4 or 5, anyone you choose, and you connect it. So you go to settings, which is on the bottom right side of this page. You click on settings, you click on new account, then you click on Exness. If you don't have Exness here, all you have to do is just search for your broker, which is Exness. Once you search for it, you will see Exness Technology Limited. You click on it, then you click on server. You make sure it is the same server that you have on your broker. You can see the server is Exness MT5 trial 9. So you select Exness MT5 trial 9. So if it is a real account, they are going to give you Exness MT5 real 17 or real 5 or real 2. You must have your server within this page, and you select the server. So I click on server 9, then the login. They're going to give me the login details, which is usually, you click on account information. You see MT5 login down there. You copy it, you put the login here, then the password. They are going to give you a password. How do you get your password? Just click on this page and click on it and change trading password. So you can just input, you can see the password there.
right? You can just copy it. This is where you get your password. You can copy it and put it in right here, and once you put it in, you log in into your account. But you can change the password here as well by just you can change the password, right? So I just changed the password, so I can just put in the password here by logging in again. Let me just put in the password there. This is the login. This is the login details, and that's the password. So once you put in the password, you see that the account has been logged in right here, and you can see the balance is 50k. The balance is 50k, the equity is 50k, and the free margin is 50k. This is the account details. You can see Exness Technologies account details, MT5 trial, now which shows it is a trial account or it is a demo account. So you can see your quotes here. These are the quotes you'll be trading, and you can as well see the bid price, the ask price, and the percentage movement of these assets or these currency pairs within a day. So you can as well use MT5, even though most of the times I use MT4 to trade, and I'm going to bring you on MT4. But MT4 and MT5 are pretty much the same thing. You use them the same way. You can search for, you can see the things you can trade here: Forex indicator, crypto group, energy group, Forex group, stocks group. The things you can trade, you can just search for GBP USD. You add it to what you have here. You can search for Euro USD. You add it to what you have on this page, and you can also edit the things you have here. You can edit them by clicking on, you can remove some of them, right? You can remove them and you can add to it. So that is it. So now, if you want to trade, all you have to do is click on the one you want to trade. Once you click on it, it's going to, do you want to look at details, statistics, chart, and trade? Click on trade, and this is where you trade. So it's more like the same way we use MT4 too. So this is MT4, guys. MT4. So this is my MT4. I actually have running trades on my MT4. I have trades I have taken this week. So I'm going to use the MT4 to explain to you how to do all these things, and it is pretty much the same. This is all the same platform. MT5 is an advanced improvement on MT4, but till today, majority of traders use MT4 to trade. So how do you use MT4 and MT5? This is the MT4 account, and once you log in your account that you have connected with your broker, this is what you see. So here is where you put the assets you want to trade or the currency pairs you want to trade. To add to it, just click on this button on the top right side of the page. Once you click on the button, you see the assets available by this current broker. You have Forex pairs, then you have CFDs, then you have raw feed, you have metals, you have UK oil, you have US oil, then you have cryptos that are available. So for me, I trade Forex most times. I trade crypto too because I'm a crypto trader, but I don't usually trade crypto on my Forex account. So I trade, these are the things I trade. I've already added them to the MetaTrader 4. If I want to remove them, I can just click on the page or the link on the top left side. I can select some and remove them and click on delete on the top page by the right. So, but I'm not deleting anything. Let me just leave them. So if I want to trade, all I have to do is click on any of these assets I want to trade. So let's say I want to trade gold. I click on gold. I click on trade. Then this is where I buy. So if I want to use market execution, I put it on market execution. But if I want to use buy limit, which is limit with, I click on buy limit. If I want to use sell limit, I click on sell limit. If I want to use buy stop, I click on buy stop. If I want to use sell stop, I click on sell stop. So then I'll put the lot size I want to use. You just click on 0.5. 0.5, it is one lot. Depending on the size of your account, you click on one lot. Then which price do you want to enter? What is your entry point? I put my entry price, I put my stop loss, I put my take profit as well, and I click on place. Because this is a limit order or stop order, it is not going to execute immediately. It is the order you see right here. So you can also close it by just clicking on this and click on delete, or you click on it and you can edit it here. You can also edit it by clicking on that page, but you can delete it easily by just clicking on delete order. So once you delete it, it's no more there. And this current order that I have, if I click on this, I can close with profit. I can edit the stop loss and take profit and other things. So it is easy and straightforward. So you can look at the history of the trades you've taken today. You can see, you can look at the history of trades you have taken for this week. These are the trades I have taken for this week, and like that. So that is pretty much how to use MT4. So this is MT5. If I want to trade Euro USD, for example, I just click on trade. You can see it's the same thing. I just click on, I put in my lot size. For example, let me put in one lot size. And market execution, I can choose sell limit, buy limits, all this. So let me choose a market execution. Let me put a stop loss. Then I'll put any take profit and I buy by market. I can, okay, let me put once I click on the trade, you see that the trade is running. And once the trade is running, you see that equity has changed. Equity simply means the remaining balance after the margin of the trade has been removed. Margin means the amount you are actually using in the trade currently. If you open a trade, this trade down, the margin I'm using on that trade is $1,062. This is how much I'm putting on in this trade that I've opened. And free margin means the remaining balance I can still use to trade. Equity is the addition of free margin and margin all together, and balance is basically the balance of 50k that I have on my demo account. So if you want to close the trade, you can just close it by clicking on here. You can close position, you can modify it. Once I close it, I close, it is closed. So you can check the history. You can see that I took a trade and I took a loss of $5. So that is how to use MT.
If you have watched this video to this extent, congratulations to you. You probably have learned a lot of things about Forex trading, and you have learned how to get started with Forex trading. But it doesn't end there. You also have to learn how to do a proper technical analysis of the Forex market, and I would have loved to put in another technical analysis video into this, but it would have been like 2, 3 or 4 hours long. So I would like to introduce you to a technical analysis video I made that is on my YouTube channel, where I explain how to do technical analysis like a pro from beginner to advanced level. So ensure you find a link to that video in the description below or somewhere around this video and watch that as well, so that after getting grasp of what the Forex market is and how to do it, how to sign up with a broker, how to use a broker account, you also understand how to analyze the market and trade like a professional. Also, for all the value you have gotten in this video, I would appreciate if you can hit the like button and subscribe to my YouTube channel. It means a lot to me and I would appreciate that as well. And also, if you like to learn how to trade the Forex market from me one-on-one, I have a one-on-one program where I teach how to trade the Forex market like a professional, and the class lasts a few weeks and you learn everything you need to know and you'll be mentored until you become a pro in Forex trading. If you like this, you can find a link in the description below where you can sign up for the class and fill a form, and then after filling the form, you'll be able to have access to my contact and we'll talk about how to get this done. The one-on-one class actually costs $300 and you would get absolute value for your money. So if you like to get that, click on the link in the description below or somewhere around this video where you'll be able to fill in the form and sign up so that you can register for the one-on-one program.